Hi. So in today's video, we'll continue our discussion on the various amendments made to the Income Tax Act 1961. This is part 2, and so we'll start with capital gains. Section 54 has been amended. As you all know, Section 54 provides for exemption from the long-term capital gains which is arising from a transfer of a residential house property. Now the amendment is, in case the value of the capital gains is less than 2 crores, right? So we can invest the capital gains in 2 other house properties in India by way of purchase, right, within 1 year before the transfer, or within 2 years after the date of transfer, or you can construct another house property within 3 years from the date of the transfer, right? The most important point is, so this benefit shall be available only once in the lifetime of the beneficiary. Now, as regards income from other sources, there are 2 amendments which have been made. It's important that we understand Section 56, and then we'll be able to appreciate the amendments therefrom. Now, 56 generally provides that where a company in which public are not substantially interested, meaning thereby a closely held company, if they receive in any previous year from any person being a resident any consideration for the issue of shares that exceeds the face value of the shares, then the aggregate consideration which is received from the issue of those shares, right, in excess of the fair market value of the shares shall be taxable, right? However, exemptions have been provided in the same section itself. Number 1, if any venture capital undertaking, right, if they are going to raise money by the issue of shares from a venture capital company or from a venture capital fund, then that qualifies for an exemption. Second, there are certain companies or classes of companies which the central government by a notification in the official gazette they have exempted. This is the provision and the exemptions which are already given in section 56. Now the amendment to this section is, number 1, as regards venture capital companies or undertakings, the exemption was given to only those funds which are procured from a category 1 alternative investment fund, AIF, right? This was the exemption provided. So with the view to benefit these venture capital undertakings, now they have extended this to category 2 AIF also. So previously it was only category 1, but now they have extended to category 2 AIF, alternative investment funds. The second amendment is, I said some class of companies they are also exempted by a central government through a notification in the official gazette. And obviously, when the government is going to give you a notification, obviously it is going to prescribe a lot of conditions which needs to be fulfilled so that you can claim or avail the exemption. Now the amendment says, just in case the company makes a default, right, in complying with those conditions which are specified in the notification, then they say the consideration received for the issue of the shares which exceeds the face value of the shares shall be deemed to be the income of the company chargeable to income tax for the previous year in which the failure to comply the condition arises, right? So these are the 2 amendments in income from other sources. Now under the chapter deductions, several amendments have been made. The first amendment is on section 80C. Now, to enable the central government employees to have more avenues for tax saving investments within the national pension system, 80C has been amended to provide that any amount deposited or contributed by a central government employee into his tier 2 account, right, it will for a period of not less than 3 years, it shall qualify for a deduction under this section. This is the amendment. Then is 80CCD. The current situation is like this. Any amount which is contributed by a central government employer or any other employer into the account of an employee, which is as provided under section 80CCD, in computing the total income of the assessee, a deduction was given to the employee to the extent of the amount contributed by the government or the additional employer or the employer, subject to a maximum of 10% of salary. This is the provision. So the amendment is like this, with a view to give a lot of benefit to the central government employees, right? So this 10% has been enhanced to 14%. That's the amendment. The next important amendment is regards 80EEA. This is a scheme of housing for all. So with a view to ensure that the objective of the central government is to provide housing for all, a new section has been inserted, 80EEA, which states that interest on loans borrowed for purchase of residential house property, that interest up to 1,50,000 has been given a deduction under this section, subject to the conditions prescribed below. First thing is, the loan has been sanctioned by a financial institution during the period 14/19 to 31/3/2020. Next, the stamp duty value of the house is not exceeding 45 lakhs. That's very key, right? Third, the assessee should not own any other house property during that on the date of the sanction of the loan. And once you claim a deduction under this section, no deduction can be claimed under any other section of the Income Tax Act for this year or for any other assessment year. This is the amendment under 80EEA. The next amendment is 80EEB. This is with a view to promote the usage of electric vehicles within India. A new section has been inserted to provide for a deduction for the interest on loan taken for the purchase of a electric vehicle. Of course, the maximum limit is 1,50,000 for that, but subject to the following conditions. What is that? The loan has been sanctioned by a financial institution, including a banking company, for the period 14/19 to 31/3/2023. It's not 1 year, 4 years. So from 14/19 to 31/3/23, and obviously once you claim a deduction under this section, you cannot claim a similar deduction under any other section of the Income Tax Act. So this is the new section 80EEB. And one small amendment has been made under 80JJAA. This is for the additional employee cost. There's no major changes in this, just a couple of words have been added. Now, when we pay any salary to the or the emoluments to the employees, it is done through a account pay check or account pay bank draft or an electronic clearing system. As said earlier in the earlier amendments, with a view to encourage the other modes of payment. So the words other specified modes have been added, like it could be Google Pay or it could be PayPal or Phone Pay, whatever may be. So any payments made or any emoluments paid through the other specified modes also will qualify for a additional employee cost under 80JJAA. So these are the various amendments under the chapter deductions. Under rebates and relief, there are two sets of amendments which are made. 87A has been amended. So the existing provision is that a rebate is of 2,500 is given as a deduction to an assessee who is a resident individual whose total income is not exceeding 3,50,000. Right? Now they have amended this 3,50,000 and they have enhanced it to 5 lakhs, and the rebate is around 12,500 now. That's the amendment. Under section 89, which is relief, which is given in the case of arrears of salary or advance of salary, if you look at section 140A or any summary assessment 143 or any interest calculations under 234A, 234B, 234C, if you refer to those provisions, what they say that you need to first give credit to the prepaid taxes and other reliefs which are possible, and only after giving those reliefs you need to calculate the tax liability. The point is, they have not specifically mentioned section 89 in those sections, which means there was no clarity whether we should subtract or give the relief under section 89 and then calculate 234 ABC interest or a self-assessment tax. Now that genuine hardship has been removed now, and now that section has been amended, and those sections have been amended like 140A, 143, 234 ABC have been amended to say that first you need to give relief under section 89, and only after that you need to calculate the tax liability under those provisions, under those sections. So that is the amendment.